All right, let's just forget everything you think you know about tech revolutions being built on code. Today, we're talking about something far more basic, far more physical. We're talking about the metal that's actually building our green future, copper. We're going to dive into why demand is just set to absolutely explode, creating this massive supply gap. And then we're going to navigate the pretty tricky world of investing in it, from these hidden traps in financial markets to some of the brutal truths about the companies that pull it out of the ground.
This quote just frames our whole conversation perfectly. We all get so excited about AI and software, but none of it works without the physical world. The entire green transition, every single electric car, every wind turbine, every solar panel, it's not just data floating around in the cloud, right? It's a physical network. It's built with wires and components, and copper is the one essential, basically irreplaceable element that conducts all that green power.
Now take a look at this. The story this chart tells is pretty staggering. On the left, you see where we are today, our current global mining capacity. And on the right, that's the projected demand by 2035. That massive gap between the two, that's what analysts call a structural deficit. And look, this isn't some short-term blip. It's a fundamental mismatch. It's all driven by EVs, wind farms, solar, and just upgrading the entire global grid. The problem is really simple. You can't just print more copper. We just do not have enough new mines in the pipeline to meet this coming wave of demand. It's a real physical problem.
So, this brings us to our first big idea here. We really need to start reframing how we think about copper. For decades, it's just been this boring, simple barometer for industrial health. But now, it's transforming into something way more important, a crucial green metal. Think about the sheer scale of this for a second. A single electric vehicle uses about 4 times more copper than a regular gas-powered car. 4 times. An onshore wind turbine, that can contain several tons of this stuff. We're not just talking about a few new gadgets here. We are talking about rewiring our entire energy and transportation systems from the ground up. All that clean power has to get from where it's made to where we use it, and copper is simply the most efficient, cost-effective conductor on the planet to make that happen.
Right, so that's the multi-billion-dollar question, isn't it? If we have this massive, unmissable trend staring us in the face, how does an investor actually get a piece of the action? Well, it's not nearly as simple as you might think, which leads us right into the next part of our explainer.
Okay, so there are fundamentally 2 ways to get exposure to a commodity like copper. You can own the physical thing itself, or you can trade a financial instrument that represents it, what we call paper copper. Let's break that down.
So this slide lays out the trade-offs perfectly. On the one hand, you've got physical copper. This means literally buying bars of it and paying to store them, or more realistically, buying shares in an ETF that does all that for you. It's direct, you actually own the metal, but it costs money to store, and it can be hard to sell quickly. Then, on the other hand, you have the futures market, which is where most of the action is. It's super liquid, easy to trade, but it comes with its own, let's call them complexities, including a really nasty hidden trap for anyone who isn't paying attention.
And this brings us to one of the most important concepts for any commodity investor to really understand: the contango trap. This is a weird quirk in the futures market that can just slowly and silently drain the value from your investment, even if you're totally right about the direction the price is headed.
First, let's do a quick primer so we're all on the same page. A futures contract is exactly what it sounds like. It's just an agreement to buy or sell something like copper at a price you agree on today for a delivery date sometime in the future. Think of it like pre-ordering a video game at a guaranteed price. It's how copper producers lock in their selling price and how a company that makes, say, electrical cables locks in their buying price. And of course, it's how speculators bet on where the price is going.
Now, the futures market can exist in one of 2 states. On the left, you have contango. This is pretty much the normal state of affairs. This is when the price for future delivery is higher than the price is today. And that makes sense, right? It costs money to store and insure a physical commodity over time. But on the right, we have something called backwardation. This is where things get really interesting. The future price is lower than today's price. This is a rare and really powerful signal of intense, immediate demand and scarcity. It basically means people are willing to pay a huge premium to have the copper right now rather than wait a few months.
So here's the crucial point, and please don't miss this. A lot of popular copper ETFs don't actually hold physical copper. They hold these futures contracts. Now, to avoid having literal tons of copper delivered to their office, they have to sell their expiring contract each month and buy the next one out. Now, if the market is in contango, what are they doing every single month? They are constantly selling low and buying high. This creates this slow, steady bleed of value from the fund. We see this in other futures products like volatility ETFs, and it is an absolute silent portfolio killer for investors who don't understand the plumbing underneath.
Okay, so if futures ETFs can be a trap, what about the most obvious route? Why not just buy the companies that pull the copper out of the ground, the miners themselves? It seems direct, but buying a miner isn't the same as buying copper. It's actually what we call a leveraged bet.
The key concept to wrap your head around here is something called operational leverage. So here's how it works in plain English. A mine costs a massive, fixed amount of money to build and operate. We're talking giant trucks, heavy equipment, payroll, all that stuff. Those costs don't really change much whether the price of copper is high or low. And this huge fixed cost structure creates incredible and often misunderstood leverage to the price of the commodity.
Let's just walk through a simple example to see how powerful this is. In scenario 1, copper is at $4 a pound. The mine makes a respectable $20 million in profit. But watch what happens in scenario 2. The price of copper just goes up by 10% to $4.40. Revenue also goes up 10%. But because those massive $80 million costs are fixed, the profit doesn't go up by 10%, it explodes by 50%. That is the magic, and also the danger of operational leverage.
But, and you knew there was a but coming, right? This is a double-edged sword. That same leverage that makes you look like a genius on the way up will absolutely crush your profits on the way down. A small 10% drop in the price of copper could just as easily vaporize that profit or even turn it into a big loss.
So let's say you navigate the leverage and you get the copper price right. There is one final brutal truth about investing in commodity producers that can trip up even the smartest investors out there.
This famous quote from the legendary Charlie Munger. It might sound a little cynical, but it points to a fundamental misalignment that can exist between the management of a mining company and you, the shareholder. And the primary weapon in this potential conflict is something called shareholder dilution.
So what is shareholder dilution? Well, to put it simply, it's when a company just issues new shares of stock. When they do that, it automatically reduces the ownership percentage of everyone who already owns shares. Your piece of the pie gets smaller.
Imagine this is the company when you first invest. You own a nice, solid quarter of the entire enterprise. You're perfectly positioned to benefit from all its future success. Things are looking good. But mining is an incredibly capital-intensive business. They are always needing money to explore for new deposits, build new mines, or even just to cover their operating costs when prices are low. And the easiest way for them to raise that money? Just create new shares out of thin air and sell them to new investors.
And this is the result. Look, the overall company, the entire pie, it might have actually gotten bigger thanks to that new investment. But your slice of that bigger pie has just been cut in half. This is the brutal reality. The price of copper can double, the company's revenue can soar, but your personal stock value can go absolutely nowhere because your ownership stake has been relentlessly diluted away.
Which leaves us with this final, really critical question. We've established that this new energy economy is fundamentally physical. It's built on millions of tons of real-world stuff like copper. But as we've seen, the financial instruments that are designed to give you access to this whole revolution, from those tricky futures ETFs to the mining stocks, they are just filled with their own traps, complexities, and misaligned incentives. It really forces us to ask the question, are the financial markets we have today really the best way to invest in this very, very physical revolution?